Good morning, or good evening, depending on when you're catching this. This is SENB Hero, and this is your SENB Daily Brief. Over the weekend, crypto did what crypto does best. It scared everyone, and then reminded them why they're here. Bitcoin went from flirting with the low $60,000, absolute panic territory, to snapping back toward $70,000 in a matter of days. Not because the world suddenly got safe, but because the market ran out of weak hands. Liquidations piled up, fear hit extreme levels, and once again, leverage learned who's actually in charge. This wasn't euphoria. This wasn't a breakout. This was a reaction, a pressure release after one of the most aggressive deleveraging events we've seen in months. And here's the part most headlines miss. Markets don't recover when everyone feels good. They recover when selling gets exhausted. Today, we're going to walk through what bounced, what broke, and what this rebound is actually telling us about sentiment, structure, and survivability. No hype, no panic, just signal through the noise. Let's get into the market.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's take a look at where the market actually stands right now, not emotionally, but structurally. Bitcoin is currently trading in the $68,500 to $70,000 range after rebounding sharply from last week's lows just above $60,000. That move alone represents a 10 to 15% recovery off the bottom, one of the strongest short-term rebounds we've seen since early 2023. On the 2-hour chart, Bitcoin is clearly in post-panic consolidation. Prices holding above the immediate rebound lows, but still trading below key moving averages, particularly the 50 and the 200. This tells us something important. The market has stopped bleeding, but it hasn't healed yet. Momentum indicators reflect that hesitation. RSI has lifted out of deeply oversold territory, but remains capped, showing relief, not confidence. Volume confirms it. The biggest spikes happened during the sell-off and the rebound, and now we're seeing compression, not continuation. Ethereum tells a similar story. ETH is stabilizing around $2,000 to $2,100 after briefly dipping into the high $1,800. It's holding structure better than many expected, but like Bitcoin, it remains below trend-defining averages, a market waiting for direction, not chasing it. Solana and XRP also bounced aggressively. SOL recovering into the 80s, XRP holding the 1.40 range after a sharp liquidation wick. But across the board, the pattern is consistent. Sharp downside to violent rebound to sideways uncertainty. That's not a bull market resuming. That's a market catching its breath. Now look at sentiment. The crypto fear and greed index remains deep in extreme fear, hovering in the low teens. Historically, that level doesn't signal comfort. It signals capitulation risk has already been realized. Markets don't bottom when fear is rising. They bottom when fear stops getting worse. Bitcoin dominance is pushing back toward 59%, confirming a risk-off rotation within crypto itself. Capital is retreating from speculative alts and consolidating into perceived safety, even inside a volatile asset class. That's defensive behavior, not euphoric, not reckless. So zooming out, here's the honest read. The panic phase likely passed last week. Leverage has been flushed. Volatility remains elevated, and confidence has not returned. This rebound matters, but it doesn't settle the debate. And that brings us to the first major story driving this move. Bitcoin's violent drop below $60,000 and the equally violent rebound that followed. Let's break it down right after this.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, I got my coffee and ready to roll. First up today, Bitcoin's crash and the comeback that followed. Because what we just watched wasn't noise. It was a full market stress test. This move pulled in everyone. Retail traders were the first to feel the pain, especially leveraged longs on Binance and Bybit, where liquidation engines ran nonstop. Institutional desks weren't immune either. Flows tied to BlackRock-linked spot ETFs showed stress early in the week, then stabilization as the rebound began. And behind the scenes, whales were active. Addresses associated with long-term accumulation, including continued ads linked to MicroStrategy-style positioning. Analysts across the spectrum weighed in. CoinDesk, CryptoQuant, and Fundstrat, with Tom Lee calling this a capitulation bottom. Bitcoin plunged to roughly $60,017, its lowest level since October 2024. That completed a 30% drawdown from the highs. Then, almost violently, Bitcoin reversed. One single session delivered an 11% gain, the largest daily move since March of 2023, pushing price back through $70,000 and adding over $200 billion back to total crypto market cap. That's not a bounce you ignore, but it's also not a signal you blindly chase. The lows printed early in the week, February 5th into the 6th. The rebound ignited Friday, February 7th, and carried into the weekend as short positions scrambled to cover. Importantly, this didn't come out of nowhere. It followed days of relentless selling tied to macro fear, tariff headlines, and tech sector weakness. This was pressure building until it broke. The action was global. Binance and Coinbase led volume with more than $50 billion traded in 24 hours at peak intensity. Asia sessions amplified the downside, high leverage, thin liquidity. U.S. trading hours powered the rebound, ETF flows stabilizing, risk appetite returning. This wasn't regional, it was systemic, because the market finally capitulated. Over $2 billion in liquidations flushed out excess leverage. RSI plunged near 25, deep into oversold territory. Whale accumulation ticked up, funding flipped, and fear reached levels that historically don't last. At the same time, macro pressure eased slightly, tech stocks found footing, and tariff rhetoric softened just enough to shift positioning. Fear didn't disappear, it simply stopped escalating. That's often how bottoms form. Now comes the hard part. If Bitcoin can hold above $70,000, we open the door to $80,000 to $85,000, driven by short squeezes and potential ETF inflows resuming. But make no mistake, this recovery is conditional. A hawkish Fed pivot, renewed tariff escalation, or regulatory shocks could still force a retest of the $60,000 zone. Longer term, real confirmation only comes if regulatory clarity, especially around the clarity framework, turns from rumor into reality. If that happens, this isn't just a bounce. It becomes a launch pad. And that brings us to the broader picture, because Bitcoin didn't fall alone. Next up, the liquidation wave that wiped out over $2 billion across crypto, and why this rebound may signal capitulation, not collapse. Let's dig in after this.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
So if Bitcoin's rebound was the comeback, this liquidation bloodbath was the knockout punch. Because what just happened across crypto wasn't a normal pullback. It was forced selling at scale. More than 335,000 traders were liquidated. The vast majority were retail longs, concentrated on Binance, Bybit, and OKX, where leverage remains highest. Even whales weren't spared. The trader known as Machi Brother reportedly took losses north of $120 million. And miners, including Marathon Digital, were seen moving Bitcoin on-chain as profitability pressure intensified. Analysts tracked the damage in real time. CoinGlass, Bitfinex, and CryptoQuant, with CryptoQuant's Sean Rose highlighting a critical data point. 44% of Bitcoin's circulating supply is now underwater. Liquidations surged into the $1 to $2.5 billion range across multiple 24-hour windows, ranking this event among the 10 largest liquidation cascades ever. Longs dominated the wreckage. Roughly $1 to $1.5 billion in bullish positions were wiped out. By asset, Ethereum led, with roughly $960 million. Bitcoin followed near $680 million, and Solana added another $160+ million. At the same time, total crypto market cap fell into the $2.3 to $2.5 trillion range, while realized losses for Bitcoin hit an all-time high, approximately $3.2 billion on an entity-adjusted basis. That's not panic selling. That's mechanical liquidation. This didn't happen all at once. Liquidation waves built from January 29th through February 6th, with the most violent hits landing February 4th and 5th, right as Bitcoin flushed below $60,000. By February 7th through the 10th, daily liquidations cooled toward the $500 million range, signaling that the forced selling phase was largely complete. That timing matters. Geographically, this was amplified by Asia-heavy exchanges. Roughly 60% of liquidation volume ran through Binance and Bybit, with South Korea's high-leverage trading culture magnifying the downside. In the U.S., Coinbase reflected a different story. Less leverage, more institutional repositioning, and flows tied to broader macro risk sentiment. This wasn't a single market breaking. It was global leverage unwinding simultaneously. Because leverage met reality. Traders were running 5 times, 10 times, even 100 times positions into a macro environment that turned hostile, fast. Tech earnings disappointed. Microsoft and AMD weakness spilled into risk assets. Tariff rhetoric resurfaced. The Fed stayed firm. Liquidity thinned. And when price slipped just far enough, algorithms took over. Margins failed. Stops triggered. And dips turned into avalanches. This wasn't fear-driven selling. It was a deleveraging loop in a fragile market. That's the textbook definition of capitulation. Now for the important part. Leverage across futures markets has dropped roughly 20%. Open interest has reset closer to $30 billion. That creates cleaner conditions for recovery. If ETF inflows resume and macro pressure eases, a 10 to 20% upside move becomes realistic, not guaranteed, but viable. However, another macro shock, especially around tariffs or rates, could still trigger a second wave of forced selling. Longer term, though, this event did what markets often need. It flushed weak hands, and when leverage clears, price discovery can start again. Next up, we zoom out, because crypto didn't stabilize on its own. Wall Street stepped back in. When we come back, we'll talk about the equity rebound, tech recovery, and why Bitcoin suddenly stopped falling. Moving right along after a word from our sponsor.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
And we're back. Now, while markets were busy bleeding and rebounding, Washington quietly set a clock. And this one matters because the Clarity Act stablecoin provisions have become the central policy fight between banks and crypto. And the White House just put a deadline on it. At the center of this is the White House, with crypto czar David Sachs acting as broker. On one side, Coinbase, led by Brian Armstrong, publicly opposing the current framework. On the other, traditional banking interests, most notably the American Bankers Association, pushing to limit stablecoin competition. In the Senate, Tim Scott remains a key figure, while regulators across Treasury and financial agencies hover in the background. Ripple, notably, has stayed supportive of a compromise, but this fight extends far beyond any single company. The White House has imposed an end-of-February deadline to resolve the stablecoin yield dispute, a fight tied to a potential $6.6 trillion market. The core issue? Proposed rules would ban idle stablecoin rewards, meaning no yield simply for holding a stablecoin, while still allowing activity-based rewards, such as staking or liquidity provision. Coinbase has called the current draft dangerous and structurally biased toward banks. Why? Because banks can offer yield through deposits, while stablecoins, under these rules, would be artificially constrained. This standoff has stalled progress on the broader Clarity Act, which was supposed to bring regulatory clarity, not create a new advantage for incumbents. The deadline traces back to late January 2026, with key talks occurring around January 28th. Since then, momentum has stalled. As of February 10th, no meaningful progress has been announced. Committee markups, already delayed since January, remain stuck in limbo, which means the clock is ticking. This fight is happening in Washington, D.C., inside the White House and Senate offices, but the inputs are coming from everywhere. San Francisco, where Coinbase is headquartered, Wall Street, where banks are lobbying aggressively, and globally, stablecoin issuers and DeFi builders are watching closely, because whatever happens here will set precedent worldwide, because yield is power. Banks see yield-bearing stablecoins as direct competition, especially when products like USDC can offer returns without the same regulatory overhead. Coinbase and DeFi advocates argue the opposite, that banning idle yield kills innovation, undermines open finance, and entrenches legacy systems. And then there's the real bottleneck, 137-plus proposed amendments. These range from yield restrictions to DeFi participation limits to constraints on tokenized equities. Critics say the result isn't clarity, it's gridlock dressed up as regulation. So, where might this go next? There are two paths from here. If amendments bridge the gap, allowing limited stablecoin yield under defined rules, the Clarity Act could pass in Q1. That outcome would likely trigger a relief rally in stablecoins and select altcoins, potentially 20% or more, as regulatory overhang lifts. But if talks fail, this drags into midterm politics, prolonging uncertainty and keeping capital sidelined. Either way, the next signal won't come from markets. It will come from David Sachs and whether the White House can land this negotiation. Now, while Washington debates rules, crypto builders kept building, and one project didn't just survive the storm, it thrived. Let's talk about Hyperliquid and why it surged while everything else was bleeding. That's coming up next.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Okay, while most of crypto was busy liquidating itself into the history books, one project quietly did the opposite. Hyperliquid didn't just survive the bear move, it outperformed. This move was driven by the Hyperliquid development team, its growing base of hype holders and traders, and a broader DeFi audience looking for alternatives to leverage-heavy casinos. Analysts at CoinDesk, TradingView, and ForkLog flagged the divergence early, and the project got an additional boost from Ripple ecosystem integration, which expanded visibility beyond native DeFi circles. The HYPE token surged between 50 and 71%, reaching highs in the $34 to $37 range. That performance beat Bitcoin, XRP, and most major alts during one of the ugliest market stretches of the year. What fueled it? The launch of HIP4, Hyperliquid's prediction markets and options platform. No leverage, no liquidation engines, no forced selling spirals. Volume surged to roughly $4.8 billion in 24 hours, with open interest crossing $1 billion. In a deleveraging market, that's not accidental. The rally began forming January 19th and accelerated sharply into early February. Momentum peaks right after the HIP4 rollout on February 2nd and 3rd, with additional tailwinds from Ripple-related news shortly after. As of February 10th, HYPE remains one of the strongest performers across the entire digital asset space. All of this happened on-chain inside Hyperliquid's own ecosystem. The buzz spread quickly across X, CoinDesk, and DeFi-heavy regions in Asia and the U.S. Ripple's technology stack integration expanded reach beyond crypto-native traders, pulling in a broader audience. This wasn't hype-driven speculation. It was usage-driven growth. Because Hyperliquid solved a very specific problem at exactly the right moment, HIP4 allows users to participate in prediction markets with full collateralization. No leverage, no margin calls, no liquidation cascades. If you want to launch a custom market, you stake 500,000 HYPE, aligning incentives without blowing up the system. In a market traumatized by leverage, that design choice matters. On-chain metrics back it up. Daily revenue around $4.3 million, rising activity, and traders rotating out of risk without exiting crypto entirely. Hyperliquid became a bear market refuge. If adoption continues and TVL keeps growing, price targets in the $40 to $50 range are not unreasonable. A broader market recovery would amplify that, but macro risk still caps everything. Tariffs, rates, and regulatory outcomes still matter. The difference here is structural. Hyperliquid didn't rally because sentiment improved. It rallied because design matched conditions. And that's something worth paying attention to. Now, before we head to the mailbag, we need to close out the big picture because beneath price action and policy fights, there's pressure building at the foundation of the network itself. Let's talk about miners and why the infrastructure side of Bitcoin is under real strain. That's coming up next.
Monday morning starts here, coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
So, before we head to the mailbag, we need to talk about something that doesn't care about sentiment, doesn't care about narratives, and doesn't respond to rebounds. Mining. Because beneath all the volatility, the infrastructure of Bitcoin itself has been under real strain. This pressure is hitting miners hard. Major operators like Foundry, Luxor, and Marathon Digital have been among the most exposed. Analysts at CryptoSlate, Hashrate Index, and CryptoQuant have been tracking the damage closely. And once again, Sean Rose at CryptoQuant flagged a key reality. 44% of Bitcoin's circulating supply is underwater. That matters for holders, but for miners, it's existential. Bitcoin's mining difficulty is set to drop between 14 and 18%, from roughly 141 trillion down to the 116 to 121 trillion range. That's a major adjustment. Block times have stretched to nearly 20 minutes, double the network's 10-minute target. At the same time, miner profitability has fallen to 14-month lows. Daily revenue across the network is hovering near $28 million, one of the weakest readings of the past year. This isn't inefficiency, it's compression. The difficulty adjustment is expected between February 8th and February 10th, 2026. But the stress didn't start there. It's been building since late January, accelerated by price collapse and compounded by environmental and operational shocks. The epicenter has been the United States. Mining hubs in Texas were hit by winter storms, knocking roughly 110 exahash per second offline at peak disruption. But this isn't isolated. Global hash rate dynamics, from North America to post-ban China echoes, mean the entire network feels these shifts. Bitcoin doesn't care where the problem starts, it adjusts everywhere. This is the post-halving reality. Rewards were cut, difficulty remained high, price collapsed below $80,000. At the same time, energy costs rose, storms disrupted operations, and miners had fewer options to absorb losses. hash rate dropped roughly 3.3%, with total network power falling near 141.7 exahashes per second. CryptoQuant's assessment was blunt. Miners are extremely underpaid. When that happens, something has to give. The upcoming difficulty drop should offer temporary relief. Margins improve if Bitcoin stabilizes. Historically, stronger miner recoveries align with prices above $90,000 to $91,000. Until then, miners are adapting. Some are pivoting into AI and high-performance computing, using infrastructure to diversify revenue. Others may capitulate, selling reserves, shutting down inefficient rigs, or exiting entirely. Think of it like re-gearing for a steep climb. The engine's still running, but the wrong setup makes every incline brutal. Adjustments help, but only if traction returns. Now, after all that price action, policy tension, liquidations, and infrastructure stress, let's bring it back to the community. It's time for today's Proof of Thought mailbag, where the takes are sharp, the questions are honest, and the comments, well, they speak for themselves. Reading them all after this.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, before we wrap things up, it's time to hear from the smartest, loudest, and occasionally most confident people on the internet, which means the Proof of Thought mailbag. First one comes from @DiamondHands since Tuesday. He writes, "Is this finally the bottom, or are we just being baited again?" First of all, the username tells me you've been a Diamond Hands investor for approximately 4 business days. Here's the honest answer. This could be a bottom, or it could be a relief rally inside a broader downtrend. What it definitely is not is a guaranteed straight line up. Markets don't reward certainty. They punish it. Next up, @FedCutsAnyDayNow asks, if the Fed pivots, does Bitcoin instantly moon? I love the optimism. I love the commitment to the narrative. But no, markets don't move like TikTok edits. A Fed pivot helps liquidity over time. It doesn't erase leverage, debt, or bad positioning overnight. If it were that easy, we'd all already be retired. This one's from @BoughtTheTop again, which I respect the honesty. He says, I sold at $61,000 and now it's back near $70,000. Should I re-enter? This is the real pain point of this market. Not losses, whiplash. If your strategy is driven by emotional exits and emotional re-entries, you're not trading the market. The market is trading you. Zoom out. Decide before the next move what kind of participant you actually are. Submission number 4 is from @EverythingIsManipulated. This bounce is fake. Whales planned it. Yes, whales planned the global macro environment, the tech sell-off, the winter storms in Texas, and your liquidation price. Markets don't need villains. They need liquidity. And when liquidity disappears, price does strange things. And finally, @StillStackingQuietly writes, not panicking, still DCAing, just watching. No fireworks, no hot takes, just discipline. Those comments rarely go viral, but historically, they age the best. And that's really the theme of this mailbag. Some people are looking for certainty. Some are looking for villains. Some are looking for instant validation. But the people who tend to survive cycles like this are doing something far less exciting. They're staying solvent. They're managing risk. And they're letting the market reveal itself instead of demanding answers on a deadline. All right, let's bring this one home. It's time for the final thought and today's show close. Wrapping it up after this.
Our beans are washed in ancient waters, filtered through coal seams deep beneath the Utah mountains. Okay, not really. We totally made that up. But it does sound badass, doesn't it? Here's the truth. Premium Guatemalan beans, aged for 30 days in real whiskey barrels, then carefully roasted smooth in the golden light of California, inspired by the legendary Drunkard's Wash Desert Race in Price, Utah. Bold, smooth, with a subtle touch of whiskey and oak. Drunkard's Wash. Whiskey barrel aged, bold and unmistakable. From Whole Shot Coffee Company. Fuel your life.
Markets don't ring bells at the bottom. They don't send invitations. And they definitely don't wait for consensus. What they do is test conviction. Over the past few days, we've seen fear reach extremes, leverage get erased, miners struggle, policy stall, and yet price found buyers. Not because everything is fixed, not because the future is suddenly clear, but because forced selling ended. That's the difference between collapse and correction. One is emotional, the other is structural. This rebound doesn't mean we're back in a bull market. It doesn't guarantee higher highs, and it certainly doesn't erase macro risk. But it does tell us something important. The market is still alive. Liquidity still exists, and capital hasn't given up. It's just more careful. If you're looking for certainty right now, you're in the wrong asset class. But if you're paying attention to behavior instead of headlines, to structure instead of sentiment, this is where information matters more than opinion. Cycles aren't survived by predicting the next move. They're survived by staying solvent long enough to see it. And right now, the market isn't asking you to be brave. It's asking you to be disciplined. That's it for today's SENB Daily Brief. If this helped you cut through the noise, you know what to do. Hit that like button, tickle the little bell, and if you haven't subscribed yet, what are you waiting for? I'm SENB Hero. Stay sharp, stay curious, and as always, we'll see you on the next one. The SENB Daily Brief is a production of SENB Hero Media in collaboration with Whole Shot Coffee, coffee that fuels champion. Written and hosted by yours truly, SENB Hero. Production, editing, and scheduling handled by Maya Valencia, who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit senbheromedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.